Hello again, everybody. This is Harjinder, and this video we will be talking about topic 16, forward contracts and accounting for hedges. So first of all, what do we mean by hedging? Hedging is the practice of taking a position in one market to offset and balance against the risk adopted by assuming a position in a contrary or opposing market or investment. This is the definition taken from the Wikipedia page on hedge finance. The different types of risks that can arise from a foreign currency risk include transaction exposure that arises because of lapse in time between the origination of a transaction and the settlement. There can be economic exposure, which is basically given the fact that the present value of future cash flows can be affected by changes in exchange rates. It can be translation exposure, which is basically just the accounting exposure arising from a difference between the income statement uh, um, equivalent dollar amount and the balance sheet related dollar amount. For example, interest expense is typically translated using an average rate, but the actual amount of interest paid or accrued as payable, that is converted using the spot rate for the date of the record of that transaction. And any difference is captured as an FX gain or loss. And then we have contingent exposure, which is uh, transactional or economic risk that is dependent or contingent on the outcome of some negotiation. So that is a little bit beyond the scope of this particular course. Uh, to take a look at the basics of hedging, going by the definition that we saw, hedging needs that there be a hedged item, which is essentially a receivable or a payable denominated in foreign currency, and a hedging item, something that is affected by fluctuations in exchange rates, but in a direction opposite to that of the hedged item. And what happens is companies will often use foreign exchange derivatives such as forward contracts, futures, options, and swaps to hedge against their accounting or transaction exposure. In this particular course, we will focus on the use of forward contracts as the hedging item. A little bit about forward contracts. A forward contract is basically a contract with a financial institution, usually a bank, to either sell foreign currency and receive Canadian dollars or to buy foreign currency and then pay Canadian dollars. The rate is agreed upon and therefore is fixed as far as the actual exchange of the foreign currency is concerned, but the transaction is set to take place at a later date. And this kind of a contract is customized and is typically non-cancelable or will incur a penalty if it's canceled before term. The value of the forward contract is linked to the forward rate, which is basically um, the rate that is available today for an actual settlement that will take place in the future. So what tends to happen is as spot rates change, there will be a gain or loss on the hedged item, which is essentially the receivable or payable in foreign currency. But as spot rates change, forward rates also change, and that's going to result in a gain or loss on the forward contract, which is our hedging item. Now, the hedge will work if the gain or loss on the hedged item is offset by a corresponding loss or gain on the forward contract. So if you have a gain on a hedged item, you should have a loss on the forward contract. And so the idea is the overall impact of the movement of the exchange rates is is canceled out by having a hedged item that is impacted in an opposite direction to the hedging instrument. Now, forward contracts could be speculative. They can also be used as a hedge. Importers who need foreign currency to pay for their imports will typically hedge their accounts payable that are denominated in foreign currency by entering into a forward contract to buy foreign currency. And so, what should happen there is that gains or losses that arise on the forward contract will be recorded in income, in profit or loss, unless hedge accounting is applied. In contrast, exporters who will receive payment in foreign currency for their exports will hedge their accounts receivable in foreign currency by entering into a forward contract to sell the foreign currency. And what they would do in that case is any gains or losses that occur will be captured in P&L unless they apply hedge accounting. Now, the key to keep in mind here is that the companies are trying to manage risk and not necessarily make a profit. That said, companies can and do often get into forward contract positions for speculative purposes, i.e., with a view to make a profit. The gains and losses in that case are recorded into P&L because that a speculative contract is not a hedge. Now, you would have noticed that we had said unless hedge accounting is applied. So if hedge accounting were applied, the gains and losses may not hit the income statement, the P&L immediately. And we'll talk about hedge accounting in a little bit. So how do we account for a forward contract? Companies can use the gross method or something called the net method to record the forward contract. For this particular course, I am going to use the gross method to demonstrate the accounting for forward contracts. And so what that entails is we record a receivable from the bank and an amount payable to the bank. And at every period end, the portion that is subject to changes in forward rates must be adjusted to fair value. So what are we referring to here? If it's a contract to buy foreign currency, then the receivable from the bank in foreign currency is subject to changes in forward rates. The amount that we have to pay to the bank or the financial institution in Canadian dollars remains fixed. In contrast, if we had a forward contract to sell foreign currency, the amount that is payable to the bank in foreign currency is subject to changes in forward rates. The amount that we get from the bank is fixed. Forward contracts are reported on the balance sheet at net amount. So we basically offset the receivable from the bank against the payable to the bank. And we either will have a net receivable, which is reported as an asset, or a net payable, which is reported on the balance sheet as a liability. And we also discount the amounts for time value of money. So forward contracts are reported on the balance sheet at present value. Looking at transactions for forward contracts and hedged items, the initial recognition of a forward contract would involve recording a receivable from the bank and a payable for the bank. Whereas for the hedged item, the initial recognition of the purchase or sale with a corresponding accounts receivable or accounts payable in foreign currency. So say if your hedged item was a sale, well, an accounts receivable from the sale, debit the accounts receivable, credit sales revenue. If there's a purchase involved, you debit inventory or some kind of asset purchased and credit accounts payable in foreign currency terms. If you have an intervening year end before the forward contract or the completion of the realization of the amount occurs, then the forward contract has to be remeasured to fair value, and any gains or losses have to be booked into profit or loss unless the hedged item is unrecognized, i.e., not yet recorded in the books, and hedge accounting is applied. We'll talk about that soon as well. For the hedged item, we would remeasure the hedged item using the closing rate because it's either an accounts receivable or an accounts payable, and that makes it a monetary asset or a liability. The gain or loss goes through P&L. On the settlement or the payment date, for the forward contract, either the foreign currency is received from the bank and Canadian dollars are paid, or foreign currency is paid or delivered to the bank and Canadian dollars are received. Any gain or loss is booked through P&L. For the hedged item, either we pay on the accounts payable or we receive money on the accounts, either we pay on the accounts payable rather, or we receive on the accounts payable, accounts receivable, and any gain or loss is recorded in profit or loss. Okay, we were mentioning hedge accounting. So what is hedge accounting? The objective of hedge accounting, as described in IFRS 9, paragraph 6.1.1, is to represent in the financial statements the effect of an entity's risk management activities that use financial instruments to manage exposures arising from particular risks that could affect profit or loss. Now, that's a whole lot of gobbledygook. Basically, what you try to do with hedge accounting is to ensure that if a company is effectively using hedges to offset um, their risks arising uh, uh, or from various reasons. So in this particular instance, risk arising from changes in exchange rates. If the hedge is working, then the hedge accounting purports to reflect in the respective accounting, the financial statements, the net impact of the company's efforts. So if the company is doing a good job of managing its risks, there should be very little of the resulting gain or loss making its way onto the income statement. A derivative measured at fair value through profit or loss may be designated as a hedging instrument, except for some written options. That's good to know. Forward contracts certainly meet the definition of a derivative that could be used as a hedging instrument. A hedged item can be a recognized asset or liability, so recall, receivable or liability or payable. An unrecognized firm commitment, so that would be where we have entered into a non-cancelable contract that will give rise to either cash being received or cash being paid, or a forecast transaction. So that could be a situation where the company has ongoing transactions that are denominated in foreign currency. They've not actually happened, but they're forecast to occur in the future, or a net investment in a foreign operation. That's something to be talked about in topic 17. An entity may designate an item in its entirety or a component of an item as a hedged item in a hedging relationship. An entire item comprises all changes in the cash flows or fair values of an item. A component will comprise less than the entire fair value change or cash flow variability of an item. And that just basically means that a company does not necessarily have to hedge 100% of its position. It can choose to hedge a portion, 70%, 80%, and so on. There are qualifying criteria for the application of hedge accounting. First of all, a hedging relationship should consist of only eligible hedging items. and hedging instruments, that a formal designation and documentation of the hedging relationship uh, exists, and that of the company's risk management objective and strategy. And thirdly, the hedging relationship meets hedge effectiveness requirements, where hedge effectiveness refers to the extent to which the changes in the fair value or cash flows of the hedging item, which, keep in mind for our case, is the forward contract, are offset. The hedging item here would be the receivable or payable, are offset by those of the hedging instrument, which happens to be the forward contract. How a hedge is designated, well, that depends on the type of exposure that is hedged. Now, we can have a recognized asset or liability. In that case, the hedge can be described as a fair value hedge or a cash flow hedge. We can have a recognized firm commitment, in which case the hedge can be designated as a fair value hedge or a cash flow hedge. We can have an unrecognized firm commitment, where typically the hedge designation would be fair value hedge, but we can also use cash flow hedge if the hedge is specifically that of foreign currency risk. And that will be the case in the examples that we look at in this particular topic. And then finally, you can have a hedge of a highly probable forecast transaction, in which case we can only use the cash flow hedge designation. Okay, hedge of an existing monetary position. Both the hedged item and the hedging item, the forward contract, are recognized in the books, i.e., we have a complete hedge relationship. Well, in this case, any gain or loss on the hedged item and the hedging item are reported in profit or loss. Looking at the hedge of an unrecognized firm commitment, the hedging item, the forward contract, is recognized in the books, but not the hedged item. So essentially, we don't have a complete hedge relationship yet. The company has three choices. They can choose not to apply hedge accounting. If they do that, then any gain or loss on the forward contract will be reported in profit or loss. The company can use hedge accounting and designate the forward contract as a cash flow hedge. If they do that, then any gain or loss on the forward contract is recorded in other comprehensive income. Or they could use hedge accounting and designate the forward contract as fair value hedge, in which case the gain or loss goes through something called a commitment asset or liability. So looking at these in a little bit of detail, I have three scenarios: no hedge accounting, use hedge accounting, designate as cash flow hedge, use hedge accounting and designate as fair value hedge. So when the forward contract is signed, we would debit a receivable from the bank and credit a payable to the bank, and that would be an entry common to all three scenarios. In the intervening year end, you will adjust the forward contract, and any gain or loss will go through profit or loss if no hedge accounting were applied. We'll record the gain or loss through other comprehensive income if we had designated the forward contract as a cash flow hedge, or book it through commitment asset liability if we had designated the forward contract as a fair value hedge. When the hedged item is recognized, there's no separate entry needed for the forward contract if hedge accounting was not being applied. However, if hedge accounting was applied, then the hedged item, the forward contract, has to be adjusted. Any gain or loss goes through OCI in the case of cash flow hedge, or commitment asset liability in the case of fair value hedge. And what we do is we close the accumulated other comprehensive income, or the net balance in the commitment asset liability against the purchase or sale transaction that resulted in the hedged item of the accounts receivable or accounts payable. After this fact, any gains or losses on both the hedged item and the hedging instrument are recorded in profit or loss. When hedging a highly probable forecast transaction, we're talking about, say, a company using long-term debt as a hedge of a future sales revenue. The future sales is the hedged item, the loan payable is the hedging item. If we choose to apply hedge accounting, we must designate it as a cash flow hedge. So gains and losses on the loan payable, the hedging instrument, will be recorded in other comprehensive income. And what happens is, as time passes, a portion of the loan will cease to be a hedge, and the gains and losses on that portion will be reported in profit or loss. We will be looking at examples when we cover this topic in class. Until then, take care. Bye bye.